welcome to this special Indianomics where we are looking at the goings-on in the two largest economies, US and China, and their impact on Asia and India. The US first, the consumer price and the producer price data have shocked financial markets. While the US January CPI number came in at 3.1 year-on-year versus market expectation of 2.9, the producer price inflation was worse. It is their wholesale price inflation. It rose by 0.3% month-on-month versus market expectation of just 0.1%. This is the highest rise since 1 year ago. So, does the Fed remain tight for a longer period than the market anticipated? On the other hand, when we come to China, there is a growing fear that China is gaining more market share globally and is cutting prices aggressively, creating a deflationary force. How will all this impact emerging markets like India, our bond yields, and the Indian currency? I have with me two experts. First, Chetan Ahya, the Chief Asia Economist of Morgan Stanley, and in a bit I'll be joined by Goel, the macro strategist at Deutsche Bank. But first, Chetan, welcome to the show. Let me start with the US inflation numbers. The PPI numbers are particularly stronger than expected. Do you expect now the rate cutting cycle to be pushed and therefore the yields as well to remain strong?
So, Latha, we actually were already forecasting that US inflation will sequentially go up in the first quarter. And actually, the numbers were even surprising to us. So, this is definitely a factor that will hold the Fed back from the earlier rate cuts that markets were pricing in. We have been at June rate cut, and we maintain that. And we still think that the Fed will be able to cut rates in June. Because we're expecting that sequential inflation will begin to narrow again or decline again from the second quarter of this year. And at the same time, we're expecting that the job prints will also begin to slow. There is some residual seasonality that affects the numbers for January, and we think that January numbers were definitely bumped out a bit too much. But going forward, jobs prints will also slow. And so the combination of that sequential slowdown in inflation as well as job slowdown will allow the Fed to go ahead with a rate cut in from June of this year.
Now let me come to the other part of the US, the fisc. You know, the October, November, December fiscal borrowing indicated that, if you multiply it by 4, then it indicates that the US may run a pretty high fiscal deficit this year as well. 8.6% is what one economist calculated. If that is the case, even if the Fed were to cut, will we see too much of fall, especially in long tenor bonds? Because the Fed is going to, the Treasury is going to keep issuing them. What's the view on the longer term yields?
So ultimately, it will be, of course, the long-term yields will be driven by what is the Fed's guidance on the short-term rate path. And right now, markets have obviously run ahead and begun to discount rate cuts from March, and that's been pulled back, which has pulled the 10-year bond yields also higher. But from a deficit outlook perspective, we are expecting deficit to be at 6.1%. There is a bill that is pending in the for Senate's approval. If that gets done, that's a tax reduction bill. That will be taking deficit estimates to 6.5%. But so call it 6 to 6.5% is our deficit estimates for this year and next year.
Okay. It's just that the Ukraine war is now imposing more demands. But okay, with that, let me come to China. Your report was surprising and a little scary. Can you tell us exactly how much of a deflationary force China is? I believe they've been cutting global export good prices.
So China is definitely going to be a deflationary force to reckon with. We are seeing that right now, export prices in dollar terms are in deflation. China's non-commodities PPI index is also in deep deflation. And so these aggregate numbers are definitely indicating that. But if you look at even from a sectoral perspective, what we're seeing is that China has already been sort of deflationary for some of the large items, low value added exports like durable goods, white goods. But at the margin, where we are seeing greater pressure is the new energy transition related goods, which is electric vehicles, lithium batteries, solar panels, and even old generation chips, which is not in the new energy transition related sectors, but outside of that, it's a big component. When you look at the semiconductor sales, 40% is in this old generation chips. And China is actually exerting downward pressure in that segment as well. So it's quite wide-based export segments which are seeing deflationary pressures from China. And we think to the extent to which the policy narrative right now is that we want to do the restructuring in property sector, we want to do restructuring in the local government balance sheet, but we want to focus on good sources of growth, and that is manufacturing investment. And so, to that extent, that the government is still, driving that top-down approach to push for manufacturing investments, even while they have the excess capacities. We have to be watchful of competitive and deflationary pressure that China will send to the rest of the world.
If China is such a deflationary force, where does that leave India actually? Is it that for instance, we already hear Indian steel companies are pretty worried about this deflationary impact of China. How will the RBI react, for instance? Because we still have high food inflation. The last number we got was 8.3% food inflation, although core is falling, partly because of factors like China. Where does this leave the Reserve Bank? They're faced with this deflation, but you can't cut because your headline inflation is not 4.
So RBI, Latha, we've debated this probably in the previous sessions on your show. It is focused on headline. I think there is no going back on that. So RBI will have to look at the headline inflation. If food inflation is persistently staying high, RBI will have to look at that. So there is no debate on that front. Now, as far as India's overall implication out of China's deflationary pressures is concerned, I think it is on a macro level beneficial. Of course, there will be some sectors which will be negatively exposed. But to the extent to which India has its own domestic demand-driven strength, if you get this deflationary pressures from China that keeps core goods inflation within CPI somewhat low and gives you an overall CPI outcome which is better, and gets you closer to RBI's goal of 4%, I think it's net beneficiary. It's a challenge for countries which are more dependent on trade and exports as a growth driver. And then those companies, and that will have a negative macro effect for those economies. But for India, we think that there are other drivers to growth other than trade, and these competitive pressures will be less challenging.
So your equity analysts are not worried that cheaper Chinese steel may impact margins here. Some time back there was this huge fear. Toys, chemicals, pharmaceuticals, steel, everything coming from China was a threat and dampening Indian margins. No such fear this time.
Well, I think at the margin, it is not as bad as 2015-16 when you had China's PPI at minus 5.5%. But it's definitely, as I said, going to be negative for some sectors. But at an aggregate level, we are less worried about India's macro implications.
Okay, well, a final question on India's growth. Even Somanathan, the finance secretary, when I spoke to him, is not betting on 7, though the RBI said the number 7. What's your sense? Can there be a fear that growth has not broadened at the bottom of the pyramid? There are economists who point out urban demand is already slowing a bit, or at least not rising. As well, the PLFS, the labor force survey, indicates that jobs are increasing only in unpaid family labor, but not in salaried at the pace that one would like. So will this lack of broadening of the pyramid stymie India's growth pace?
Well, Latha, I think we are seeing that sign of broadening. There are two debates on this broadening story. One is when will the consumption trend broaden from urban to rural? And similarly on investment, when will it broaden from public to private? Whereas if you see the signs in the marginal data points, we think both those trends are already beginning to emerge. So for the consumer goods spending, the feel that we get that the rural sales is not doing well is because of the price cuts. They had done the price hikes earlier, then there is price cut. But if you look at the volume numbers, even for this December quarter, it looks like we have 5-6% real volume growth in rural economy, and that was contracting earlier. So there's a clear trend that rural consumption is improving, even for items like FMCG products. And similarly, if you look at two-wheeler sales volume, our analyst tells me that that volume growth that we are seeing in two-wheeler sales is also happening because of rural demand improving. So we are seeing that broadening out. It's just happening.
Okay.
And one other thing that I would like to highlight is that when we are thinking about rural consumption and broadening out of consumption, this cycle will be similar to what happened in 2003 to 7, where initially it was capex that was picking up, and consumption was lagging. And within consumption, the urban consumption started to do well, and then rural consumption was picking up. Because as such, understand that the rural economy does not have any big indigenous source of income other than agriculture, which is growing at 3%. So it has to be the migration of rural workers to urban, and then them doing the transfers to the rural economy. And whatever is the government support in terms of redistribution spending. So the big driver tends to be the urban economy first, and then consumption.
Yeah, urban economy and the urban remittance, and perhaps that leading to an overflow of growth to rural areas. We are looking forward to that trend. Perhaps it will pick pace after elections. Thank you very much, Chetan Ahya, for your analysis of the impact of the US and Chinese economies on India. We have to take a quick break. Thereafter, we are going to be joined by Goel, the Global Head of EM and APAC Research at Deutsche Bank, for an analysis of the same three economies from the market side. Welcome back to Indianomics. We've been discussing the issues of rising US inflation and the deflationary force in China. To discuss how Indian yields will move and the Indian currency, I have with me the head of global EM and APAC research at Deutsche Bank, Goel. Samir, thank you very much indeed for joining us. Let me start with the US. We saw those US CPI and PPI numbers coming in higher and the yields rising. What is your estimate of the way the Fed will move and the way US yields might move?
So, Latha, obviously the inflation numbers last week in the US, both the consumer price and the producer price numbers were higher than expected. And I think it's just not about the numbers being higher. I think they very seriously call into question the idea whether we have seen the best part of the disinflation process already over with the US, and similar to the concerns with a lot of the Fed speakers have been voicing, is it that there is a big last mile issue on inflation in the US, and how quickly they can get confident about being able to get to their target sustainably for inflation at around 2%. Now, I think in terms of numbers, what these prints from last week do is only marginally impacted our own forecast for core PCE in the US, probably being still at moving down to about 2.3% by the end of this year, and which should be largely in line with allowing the Fed to be able to start to cut rates by the middle of the year. But it does raise issues about whether and how quickly and how closely we need to watch the inflation trajectory in the US to be able to get the timing and the scale, the quantum of that easing through. The markets have already pulled back on their expectations of the Fed cuts pretty substantially. At the start of this year, we were pricing in close to about 150, 160 basis points of cuts for 24. We are now pricing in less than 90 basis points. So I think the market narrative has very clearly moved closer to the Fed in terms of its concerns about how sustainable this path of disinflation here is.
Okay, but for us in India, the more important point is the shadows cast by the 10-year bond yield on Indian bond yields. Now, what is your estimate? There is also this fiscal angle. Being an election year, we could see a repeat of the first quarter, the October, November, December fiscal deficit getting extrapolated, in which case the US fiscal deficit could even go to 8%. So do you think, therefore, that the bond yield doesn't fall much, the 10-year Treasury yield? What's the range you're looking at?
Yeah, so I think the treasury yields do feel like they are fairly well supported here, and especially sort of north of 4%. I think there are several dynamics, of course, which go into treasury yields. It's not just about the Fed view, it's also about the quarterly refunding announcements which have come out, which seem like the worst of the duration supply is kind of past us, but obviously concerns around elections and about what that could potentially mean for fiscal policy, though a lot of that is, I guess, more of 25 rather than an issue for 24 immediately. The Fed's also been expressing concerns around quantitative tightening and as to whether they will necessarily continue with that same pace. I think a lot of these dynamics come together to our mind to suggest that you will see a bit of a support here as far as treasury yields are concerned. We still think the curve will bull steepen. Right now, you're seeing the 2-year, 10-year spread at being close to about minus 40. We think by the end of this year, we flip to about plus 40 basis points, but that's largely as the front end yields come down. I think the back end yields we feel around in the 420-25 region seem fairly well supported. There is even a risk that if the current sort of trend of good data continues in the US, that we actually see the yields move up a little bit further before, to our mind, settling by the end of the year at around this 415, 420 levels.
Oh, really? You expect it to go even higher. In that case, where does that leave, say, Indian bond yields? Your own report, I think my chat with you earlier, you had suggested that yields could come down because of the bond index inclusion. The Indian borrowing program is also lower than what the market was estimating. So what are your yield expectations on the Indian 10-year? And will that be spoilt by the US yields remaining very high?
So I think the US yields are a factor to the extent of determining, if you might, the timing of how quickly the yields can reprice, not just in India, but most of emerging markets. But I think ultimately the direction of travel is very clear. I think in the case of India in particular, we've always thought that the beta to US yields is relatively low compared with a lot of other emerging markets. India as an economy has proven to be a lot more insular to the volatility in the global economic and rate cycle. Like you said, the longer term narrative around bond index inclusion, the fact that we are well on the path for fiscal consolidation, and that's largely meant that the bond demand supply dynamics has become a lot more favorable towards for India into FY25. Obviously, our outlook on RBI, we still think the Reserve Bank will be in a place to potentially change its stance by April and maybe start cutting rates by June. We still think we'll probably get about 100 basis points of rate cuts in fiscal 25. I think a lot of that comes together for us to remain relatively fairly constructive on Indian bond yields. Our targets being, at least the first initial targets being to get to about 675.
In that case, where does this leave the rupee? The Reserve Bank has held it in such a tight range, 83 to 83.3 is all that it has moved despite all these vicissitudes. Now will it rise? And the other point that some market guys point out is that the Reserve Bank also has one eye on the CNY rupee exchange rate. So can you also tell me whether the CNY will be allowed to depreciate simply because it looks like China wants to look at the export way out of its current slowdown?
So Latha, I think the way I look at the rupee, there is, and as you have also actually enunciated, I think there is multiple cross currents here. For the rupee. I think on the one hand, one very critical factor will be whether we actually see a more pronounced dollar down cycle happening, which at the moment seems very constrained by the fact the US as an economy is clearly outperforming the rest of at least the developed world. I do think versus emerging market currencies, the dollar will be more influenced by growth considerations than rate cycle considerations. But nonetheless, the dollar seems on, at least for now, a relatively strong footing. For India itself, the currency is not necessarily cheap when you compare it to inflation differentials with India's trading partners or on basic balance front. But on the other hand, we do have potentially better flows coming up ahead, both in terms of whether they do into equity markets at or following the elections, and certainly into fixed income because of the index inclusion issues. I think ultimately the deciding factor would be whether policy permits those flows to come into the market or intermediate it as to whether is keen on keeping volatility very low or allowing that to translate into better appreciation and gains for the currency. I'm personally biased myself to think that the currency will probably towards the latter part of the year be somewhat stronger than where we are. But I think still very much contained within a range.
No, I must get your view on China. Uh, do you expect that because of this, manufacture your way out of the current problem, China is actually capturing global market shares, even in cars, EVs, lithium batteries, and they're cutting prices. They're seen as a deflationary force. Where is the CNY expected to go? Will it depreciate? And if it depreciates, is there a chance the rupee may depreciate rather than appreciate?
So I think on the renminbi, Latha, one point I would make is I think what is often misunderstood is that while there is clearly benefits to a weaker currency, especially to one which is quite as much of a manufacturing sector as China is, there are definitely benefits to a weaker currency in terms of gaining more competitiveness, but there are also costs to a weaker currency, and particularly in terms of engendering an expectation cycle, which can actually cause the depreciation to build on itself. And to that extent, for policymakers, there is a very clear cost-benefit analysis there. And they have thus far responded to what has been relatively negative news on the China economy and the China business cycle by leaning back against, pushing back against any of that weakness in the currency. I think ultimately it's a policy choice to make for them, but it's not clear to me that from simply the benefits of gaining more competitiveness necessarily outweigh the cost to them of allowing sharp depreciation in the currency. To take place. So you're right that for the rupee, the renminbi will be an important factor, but I think the cross is no longer at a level which creates a huge amount of concern for the Reserve Bank.
Okay, you don't have a CNY level for range for the year?
So our view is that if anything, if we see a positive momentum build up as you get a positive policy stimulus in China, there is very much a risk that the renminbi actually appreciates up towards 7. So not a very large amount, but a modest appreciation, but very predicated on whether we see the kind of policy stimulus which is required for growth to outperform China in China at around that 5% level.
Thank you very much for joining us, Samir Goel. So the key takeaways, Indian yields are about to fall to about 6.75, but the rupee may be more ranged and maybe appreciate just a wee bit. That's it on this edition of Indianomics. Thanks much for watching.